Good day everyone and welcome back to another lesson with me, Jabulani Shabalala. If it's your first time here, please ensure that you watch previous videos. Before we continue with the lesson, here's a quick test yourself quiz. Give two denotions of folio and give two examples for each. What is a trial balance? How do you balance a trial balance? Where do amounts from the trial balance come from? Today, we will be covering Learning Unit 7, Bank Reconciliation. Reconciliation means to correct or fix something. In this chapter, we are correcting errors made by both the business and the bank when recording entries in the books. A mistake could have been done by the business or the bank. A company should always have the same information as the bank because whatever the business would have received should show on the company's bank statement. This is not always the same because of adjusting or timing differences. A bank or the business might have recorded an incorrect amount in its records, which will eventually result in misstatements. The business might have recorded an entry later than the bank, and this causes a difference because some amounts might be missing the records for the correct month. An example to explain this further is, for an instance, if an amount of 25,000 Rand is captured on the 31st of the month by the bank, which is the last day of the month. The bank might have gotten this on the 31st as it was a direct payment by a debtor of the business. The business closes its books on the 31st and the 25,000 Rand might not reflect on the records because it did not reflect immediately on the same day in the records of the business. The 25,000 Rand might only show the following day, which could be the first of the following month. This means that the bank and the business will be speaking different languages because the 25,000 Rand will not be showing in the books of the business on the same date. This then leads to a timing difference. Looking at the bank statement of the business, you need to remember that it is not the same as the bank account. Bank account is the business's account which shows funds available, funds received, and funds paid. It is an asset and therefore increases on the debit and decreases on the credit side. Bank statement is prepared by the bank based on our bank account and therefore works the opposite. To help you remember, let's take it like this. In a transaction, there is a debit and a credit entry. If a debtor was to pay us 10,000 Rand, we will increase our debit side of the bank account with 10,000 Rand as we have received, but on the bank statement, it will show on the credit side, not the debit side. This therefore means that on the bank statement, every amount received will be recorded on the credit side and every amount paid will be shown on the debit side. There are a few steps to follow in order to successfully balance off the bank reconciliation statement and ensure that the business has the same records as the bank. Remember that cash book receipts and cash book payments are books prepared by the business, while the bank statement is prepared by the bank. In order to start the process of reconciling, we have to compare the books of the business with the bank statement so that we confirm if all entries appear on both the bank statement and books of the business. Step 1. Compare the cash book receipts with the credit side of the bank statement. Credit side means money came in the business according to the bank statement, and therefore cash book receipts is the correct journal we should compare with. In the case whereby an amount only appears on the cash book receipts and not the bank statement, then we will need to let the bank know of this by posting the entry in the bank reconciliation statement. And if an entry appears on the credit side of the bank statement but not the CBR, then it means that we have to let the business know of what it missed by updating the cash book receipts with that entry. Step 2. Compare the cash book payments with the debit side of the bank statement. Debit side means money was paid out in the business according to the bank statement, and therefore cash book payments is the correct journal we should compare with. If an amount appears in the cash book payments and not the debit side of the bank statement, then we let the bank know of the entry by posting in the bank reconciliation statement. If an amount appears only on the debit side of the bank statement but not the CBP, then we let the business know by updating the CBP of the company with that item. Step 3. Balance both the cash book receipts and the cash book payments by taking all amounts that appeared only on the bank statement to the correct journals. Open a general ledger bank account and post your totals to this account, whereby the total for cash book receipts will be on the debit side and the total for cash book payments is on the credit side. Step 4. Bank reconciliation statement is the final step whereby you start with the balance as per bank statement. This balance, you get it from the bottom of the bank statement, and it is the last balance we see there under that bank statement, followed by any outstanding deposits, outstanding EFTs, and balance as per bank account. Balance as per bank account is the amount you would have gotten from balancing the previous bank account. Now that you are familiar with the steps to follow, I would like us to do an example practically following the steps I had given previously. Step 1. We compare the cash book receipts with the credit side of the bank statement and can see that 4,300 Rand only appears in the CBR but not the bank statement. We therefore need to let the bank know by recording the amount in the bank reconciliation statement as a deposit. We also have 1,000 Rand that only appears in the bank statement but not the CBR. Therefore, the bank is aware of the entry except for the business. Hence, we need to record the 1,000 Rand under CBR to let the business know. Step 2. We compare the cash book payments with the debit side of the bank statement, and we can see that all entries agree with each other except for the following: 232 Rand and 1,250 that appear only in the CBP and not the bank statement, which means that the business is aware of the entries but the bank is not aware. We have to let the bank know by posting in the bank reconciliation statement. On the debit side of the bank statement, 450 Rand, 22 Rand and 48 Rand appear only on the statement and not the CBP, which means that the bank is aware of the entry except the business. We should include these on the CBP to let the business know. Step 3. Totals for all journals are as follows. CBR, the total is 16,740, and for CBP, 10,637. After totaling our journals, we need to balance our bank account to check if the balance brought down balances with the one on the bank reconciliation statement or not. Bank already has an opening balance of 4,700 Rand and should be recorded on the debit side as it is favorable. The balance will be followed by CBR total on the debit side, as this is money we received. Then we record CBP total on the credit side and balance our account. Balancing the bank account will yield a difference of 10,803, which is our balance brought down. The last step is compiling a bank reconciliation statement. We will start with the balance as per bank statement of 7,985 Rand, and this is the last amount on the bank statement, followed by outstanding deposit of 4,300 Rand, which is from CBR, then outstanding EFTs from CBP of 232 Rand and 1,250. Lastly, being the balance as per bank account. Opening balance, you add it together with outstanding deposit and deduct EFTs to have the balance of 10,803, which is the same as the balance brought down on the bank account. Remember that the business should always reconcile with the bank to ensure that there are no misstatements on financial statements and all records are correctly presented. With that, continue to speak the international language of business. Until next time, goodbye.